Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. It's going to be a great one. I'm really excited to have with us today Leif Abraham, who is the co-founder and co-CEO at Public.com. Public.com is a digital brokerage platform for a whole bunch of really interesting asset classes, so we'll talk about that, as well as his background across design, product management, and getting into fintech and growing out one of the larger digital investing footprints out there. With that, Leif, welcome to the conversation.
Good to see that.
Thanks for coming on. I've been watching and admiring Public for quite a while, and I think now is actually a very interesting time to talk about digital brokerage. But before we get to Public, can you tell us a little bit about sort of your DNA and your sets of interests earlier on in your career? Like, what were your travels through the design world, the creative world, the venture world? Like, how did you start your career?
So I basically started off by just making stuff. And so that really was, and that kind of drove me into design because it was just, one of the ways of how I could make stuff. And think of it as like back 1999, 2000 as like a kid, literally in my kid's room building websites about video games.
Which video games did you make websites about? As a fellow kid that used to make websites for video games.
It started off really as just like a general news site about PC games. And then from there, basically went into, like at the time, there were all these fan sites for specific games like Counter-Strike and Command and Conquer was one of the games at the time and things like that. And basically, obviously, that was just like one of the topics that I had interest in as a child. Like, all, kids will likely have interest in video games. And that's really what was just like the excuse to kind of tinker was to do something within that, like within just the interest in video games, right?
I remember having a cracked version of Photoshop and designing a banner for a Diablo 2 library website. I'm not sure it ever got used, but it was a really good logo. I'll tell you that.
But that was the thing. It's like at that time, all these sites were run by kids like you and me. And it was all fan driven. And, all the mods and, skins and maps and all that stuff you could basically download that was, fan generated. That all came together within these like bulletin board communities and stuff. And servers at the time were super expensive, right? This is pre-cloud computing, AWS and so on. You literally, had to buy a machine and put it into a server room somewhere and then, pay for the bandwidth and stuff like that. And all these sites had, basically bandwidth issues because that was really what was expensive. Like expensive was having a bunch of files on these servers to download them and so on. And, I had a let's call it lucky hand and some, affiliate marketing and things like that. So, I kind of made some money on that stuff pretty early on. And so I started funding these fan sites for these video games, basically just like paying for their expenses. And then in exchange, got the rights of like all their ad inventory. And then that became like an ad network for video games in Germany back in the day. And so that was like the first company you can say, but this is literally out of my kid's room from like, when I was like 15, 16 to 18, 19 years old. So.
Got it. Okay. So you're using the emergence of internet and fan communities to back into an advertising business. What happens after that? So the folks who are running these fan sites, they were also all in these clans, basically, like in these, groups of, gamers. And so they started trying to hack each other's websites, AKA my servers. And so I suddenly was in this trouble. Like I'm not a DevOps engineer in any regard. And so I would say like my infrastructure was very vulnerable. And so they just started to, basically like hack each other's servers all the time. And so all that stuff went down.
had all these issues. And, then obviously, the guys who were running the sites on my infrastructure obviously were calling me up late at night of like, because the server got hacked again and was down and stuff like that. And so at some point, it just became such a headache that I just shut it down pretty much from one day to the next. And that's when I used, it's called like the skills I acquired by doing that to study design. And then shortly after, I basically ended up in like ad agencies on the digital side to, also just based on that experience, basically.
Pay with a tweet. What was that? How did that work?
So a buddy of mine and I, we moved to the US together in like 2008. That was a time where, Twitter just became pretty was just becoming sizable, Facebook the same and so on. And so there was like a lot of change happening in terms of just like digital marketing and stuff. And so we wrote this little book at the time, but we did that not necessarily to now, hit the conference circus and, try to make money in that regard. It was really more of like, let's try to make a name for ourselves and, and get our thoughts on paper. And so we had this little goal of like, okay, what does success look like? And for us, success was like, hey, what if everyone would tweet about it? And that basically created this idea for the system, which was called Pay the Tweet, which, at the time was novel. By now is a pretty normal growth idea, I would assume. But basically the system where you could offer anything for the price of a tweet. And so literally just you click a button, you tweet about it, and then it gives you access to whatever that content or product is. And that just went completely viral and nuts. And, all major record labels used it to give like songs away for artists. Mitt Romney used it to, give away his like jobs plan when he ran for president and so on. So that thing just went completely viral. But at some point it was just, are we going to keep running this on the side? Are we going to make this a real business? Or, what are we going to do with it? And so we sold it to a company builder back in Germany, who then incorporated it, turned into a real company and stuff.
Interesting. Yeah, because you must know that Pay with a Tweet was screenshotted and used by many consultants talking about digital transformation and the attention economy. I was definitely guilty of, talking about how to figure out how to monetize the attention economy and that attention is capital. And of course, in the crypto world and Web3, we've seen that taken to the extremes where attention is tokenized, traded, used as currency and all that. But I think it was very prescient in the early days to connect that act to the idea of payments, even just in the brand itself.
Totally. And what was interesting for us at the time was, number one, so when we put it out really, like the first thing why we put it out was really just to promote our own book, right? And we actually put the book on Amazon. You could buy it for a real price. But then you had the alternative of using Pay with a Tweet. What was interesting in that, it gave an anchor for the value of the book. And so in that moment, you could suddenly make an argument that like, oh, so this tweet is worth $30 of what you would usually pay for the book, right? And so having this anchor, was actually super interesting in order to like really create some perceived value for that tweet. And then the other piece that we recognized was the power of a good name. Because in theory, you could have called this the viral growth machine or whatever, But by just positioning it as a payment versus some sort of like, growth viral marketing product, that positioning created that idea that you're talking about, right? And created that perception. And that actually led to a lot of press, which led to a lot of growth of the system itself, because of this kind of cultural idea that people were tapping into of like, what is your network on social media worth, and so on. And so that combination of that anchor and positioning it as a payment versus a viral marketing product, that really was, I think, what was a big part of why that became so organically successful.
So far you've talked about kind of figuring out how to ride the rails of community and the shape of the internet, building an advertising business, starting to get closer into design, building the attention economy into something that starts to feel like FinTech, even though it's still very novel. How did your career take you deeper into investments and deeper into FinTech? And what's the connection, from that to public?
In New York, I joined this incubator called Prehype. And Prehype was basically just a bunch of people in an office in Chinatown building stuff. And that was run by this Danish guy, Henrik Rødelen, who's also the co-founder of BarkBox, a subscription box for dog toys and so on. And he just basically always just like brought people together to just tinker and make stuff. Out of that, a bunch of companies came, Roman, for example, came out of it, Barkbox obviously came out of it, sort of. And when I joined that, I kind of had this handshake deal with Henrik of like, hey, I'm going to help out on a bunch of projects, but then I want to start a company out of this again. And out of that, I ended up starting Endco, which was basically freelancing software, like payments, invoicing, expense management, task management, that kind of stuff, like a typical kind of SaaS thing. Part in this kind of pre-hype group was also Yannick, my co-founder now in Public. And so we kind of know each other through Henrik, basically. Yannick always has been deep in FinTech. He, ran kind of like a B2B trading API out of the UK. And so after I sold my company and he sold his company, we kind of were both in this place of what to do next. And that's when we kind of came together and just like experience a little bit like two of the main issues of why people haven't been actively investing, which was really this one side of this structural barrier of, at the time, Amazon being a $2,000 stock splits were not necessarily popular at the time. So, single shares became more and more expensive. For a normal person, it became really hard to build a proper portfolio just because single shares were so expensive. And so we solved that issue by being the first to put out real-time fractional investing. Did that in September of 2019 with the launch of Public. And then the other piece was this like psychological barrier of people just thinking that investing and just finance is not for them. And I think specifically on active investing, it's because the culture you've seen around that was just a very, kind of speculative culture. And so you would think of, your typical day trader looking at candle charts, and you would think of, David Day Trader on Twitter, and you would think of, Jim Cramer and so on. And that just didn't necessarily lend itself to like a mainstream mass consumer product, because people were kind of afraid of that kind of culture. And so by adding the social layer to Public, which was a big part of, especially when we started, it helped to break down the psychological barrier, because people could find and see other people like themselves being active in the markets, see how they comprehend and handle things. And that, we believe, just like creates a lot of confidence for folks. And so the combination of the two was really what kind of made, like the first version of Public of what it was.
Okay, so let me push a bit on the topic, because this is a space that I spent a lot of time on. And, I'm curious in exactly how you were entering the market, right? So how does 2019 look in FinTech? 2019 is at a time where the robo-advisors have largely kind of saturated. We're still at zero interest rates, so they've largely saturated. Wealthfront, Betterment are each at around 15, 20 billion, something like that. We've got Robinhood being loud and seen as a success story. And then on the banking side, we're starting to see Revolut, Monzo in the UK. And then we've got kind of Chime, and it's just the beginnings of their growth stories with lots and lots of customer acquisition. In that landscape, right, where it looks like there's a lot of tailwinds for digital user acquisition and so on. And then also SoFi, I think, maybe had just or was about to add to their student lending product the cash account and some of the wealth management stuff that they did. So you're looking at the space at that moment of time, and there's a lot of kind of fighting for different personas of investors. There's the passive investor into the robo-advisor, the super active investor into Robinhood, and of course you got the Schwabs and Fidelities of the world out there. And you're looking to enter with a digital broker and kind of compete at scale. What was that initial thought? Like, how did you scalpel your way into the market to get the foothold from which you've grown?
So I think if you look at the first class of these trading apps, let's say, so let's talk about those first versus the robo-advisors. I think a lot of that was still built around more speculation and speculative products. And I think it is obviously because these can be high ARPU products, right? Like you can make a lot of money quickly on the behavior that is, might be, can potentially be closer to gambling than investing, right? Let's be straightforward. I think you've seen that in the US with options trading. You've seen that in Europe with CFD trading. And I think the first generation of these trading apps really were focused around that stuff. Then you had your robo-advisors, which is the other end of the extreme, where it's really, more obviously very long-term investing, very, potentially even retirement focused, so to say. And it's a very rational kind of decision in terms of, hey, I feel I have some money. I need to do something with it. I don't know what to do. So I'm going to give it to a robo-advisor. If you look at those models and you look at that as a spectrum, and on the one end, you have your active trader with those, more option CFD type of, focused products and business models. And on the other end, you have your robo-advisors with your, call it more like asset management fee type of products. It's really two ends of the extreme. And so what we really thought with Public was to really be in the middle of that. And so if you look at the active trader, it can be high ARPU, but also very high churn. And in the most active speculative traders, you also have this dynamic where your most profitable users are the ones that churn the most. And so you will always end up being a little bit in the game of continuing to acquire new customers all the time. And then on the other end, you have potentially, very reliable, borderline recurring revenues because their asset base and those assets hopefully grow over time, fairly low churn, but you also have very long paybacks because you have to build up those assets in the first place. And also likely a little bit less engagement because, how often do you log into a robo-advisor necessarily, right? And so what we really saw was to build this kind of middle. And we had this thesis around what we internally call the engaged investor. And so someone who is actively building their own portfolio, they might have a thesis around a certain company or a certain asset. And so they are still picking, to that regard. But their engagement is not coming from the speculation and the day trading. Their engagement is coming from managing their portfolio, which is highly correlated to experiencing and just being more active in following the markets. And that's why content, social, data around companies, things like that are a big driver in the engagement at that moment. And so you suddenly have a model where you have high engagement, but you also have low churn. And that is a little bit what we define as the best of both worlds from those two ends of that spectrum when you look at the market. And that's really what we've built for, right? And that's why in the early days, we did not immediately, launch things like options trading, which we still haven't. We'll come at some point, but we still haven't. Because it's also about how do you introduce users to the app? How do you introduce yourself into the industry and into, people that come into what is the purpose of what's the intent of the type of engagement that you're trying to build over time. And therefore also just the brand you build around your product is heavily driven by the products you sell, right? Things like that. So that's what we looked at. We looked at it from the lens of building for this engaged investor persona.
That's super interesting. I've always struggled with this active-ish persona because I think it's so hard to nail it, to get it right. And I think the characterization you have, while it sounds extreme, it really is the case. I think it's a result of the market shape that it's easy to build for the sort of prosumer, really trading-oriented person who's very self-directed, as well as for the person who's this stuff's too confusing. I don't want to just do it for me. Give me a smiley face and a button. And it's hard to build for that middle, and you've seen companies, the older companies in the space that took a swing at it from Covestor to Motif, that had a great story, but weren't able to nail the customer segment. The other conversation that kind of comes to mind is M1 Finance. I don't know if you bump into them very much in terms of your targeting, but they also tell a story about kind of going after the customer who wants to have some control over the investing experience, but still wants a lot of automation and sort of comfort rather than, chasing returns. So I'm curious to hear your response to that, as well as from a product perspective, like a UI UX perspective, as well as from an investment selection perspective. What is it that this persona wants? How is the experience for this persona different than the one for somebody who just really wants to trade a lot in terms of how they engage and experience the application? And then in terms of from the financial product side, what is it that they hold?
First, I would bring in the context that I believe that this persona is where you see the most growth in the market. The day trader type, that market size pretty much wobbles with the economic cycles, right? Until the end of last until the end of 2021, let's say, that might have grown, but then it's shrinking a little bit again. And you will just always see how everyone who's trying to serve that segment, it's a very profitable segment, of course, but everyone who's trying to serve that segment, that TAM is fairly defined. It's not going to continue to grow forever, right? You're not going to have 200 million people in the US being day traders. It's not going to happen. And so it's going to be highly competitive. And, where we believe you're also just going to see the most growth is in this segment where people are slightly active. They're not completely passive. And that's also what we're seeing. We're seeing that most growth comes from market events. And market events in 2020 might have been, COVID stocks, for example, and sports being off and people being at home. In 2021, it was crypto rallies and meme stocks potentially is like the largest ones. In this year it's US T-bills, for example, and the interest rates are so high, and suddenly you can get 5+% yield on your cash potentially. But like that drives acquisition, right? Those moments drive acquisition, and with that you can basically think about it as everyone enters the market through a certain asset class. And I think crypto is a great example for that, right? You have seen a whole generation basically entering the markets with crypto being the first asset class that they adapted. And that created a lot of new investors. Now you can have your opinion on how speculative it is or not or whatever, but you cannot argue with the fact that it brought a lot of people into the markets and therefore also was an initiator for a lot of people to really start to build their financial literacy and start to build portfolios and maybe get into investing into SPY at some point, and so on. And that's really what we've seen, right? And so the TAM expansion comes, we believe, from people who start out more active. And then you have a lot of people who become more passive over time. But we don't necessarily believe that most people start off passive, that is the easiest also way to acquire folks and so on. And what we've just seen, to be quite honest, is that that's not where the paybacks are great, right? The paybacks are good if you focus on your acquisition around market events, if you focus your acquisition around people that start with a specific asset or a specific asset class and are a little bit more active. And then some people chose to be more passive over time, but that is really where we see the TAM expansion happening.
That's an interesting insight. And I do think it's an underserved segment because it's hard to do it. You have to be a lot more hands-on in going after it. Kind of just double clicking on the question from before, what's the user experience that's right to strike the balance between like engagement, like, news, wiggly lines that blink around and make you have feelings, and sort of mental safety and a clean financial health experience? How do you design for that? What do you prioritize?
I think it's very much also obviously driven by first the products you offer and the experience around how you help people build a portfolio. And then the content around it is really around giving people context around the markets. And so if you open your app and you see, the wiggly line that you're talking about, right? If you see that red line pointing down and to the right, and you have no context, you might end up just panic selling and stuff like that. You might end up doing quick emotional decisions that might not necessarily be right for you as an investor. And what really things like community and data that sits in context. And for example, in the app, we have these little cards that we call Why Is It Moving that sit under stock charts on the stock page. Like if a stock goes up or down drastically in a day, we'll actually try to tell you of why that's likely happening and give you that context. And I think that is what actually will help people to build the literacy, to encourage them to continuously do research about companies even after they own them. And I think that is really what that content and that engagement kind of needs to be about, versus just the, call it stock tip, type of potentially speculative, kind of culture that can be created in some online communities and so on.
The question I have around products for you and the order in which you added different products, financial products, how did you figure out what the different demand was from your customers, and what was it like to integrate the various financial instruments? And the framing for this is that the market venues and the market structure for being able to trade equities versus to trade mutual funds versus to be able to offer crypto or treasuries, that market infrastructure is quite distinct. How do you work? Like, are you a broker dealer that plugs into third-party custodians? Are you running your own? And how do you cover these asset classes? And maybe if you could tell the journey of getting to the place where you are now.
So we obviously very heavily believe just in the sort of say power that it can have to have as many asset classes as possible within the same experience, and giving people the opportunity to build a multi-asset portfolio, for lack of better wording, within the same place, because that will help you just to be a better investor and so on, right? To be able to move your dollars around between different asset classes the way you like and not having necessarily to change accounts and wire money around all the time. Now, obviously, we started in stocks, and that's just where we started because we were focused on the stock market. And then it was really for us, this on the one side, what do our users want and what they're asking for? And where do we predict the markets are going? Because we're still fairly early, right? We have 3.5 years in market, and there's still a lot of different asset classes we have on the roadmap. We want to bring out a lot of different instruments we want to bring out, but I just mentioned options earlier and so on. And so there's still a lot of work to be done. And so it's really just a question of prioritization because we're still in the mode of building a lot, right? And so for us, it was really, we started off with stocks. Then in, I think, November of 21, we launched crypto pretty late, I would say, compared to, many other folks. And then from there, shortly after, we did this acquisition of Otis, which we then integrated fairly quickly, which basically led us down the path of alternatives investing. And so like Reg A Plus, which is a regulatory framework in the US, which basically lets you, turn pretty much, any asset, any physical asset into like an SEC registered security that you can trade. And so that made it possible to invest in things like art or, rare sneakers, high fashion items, things like that on the app. And then obviously now we did treasuries. And treasuries was one really where when the Fed started to go back to hiking the rates again, we did not have any yield product really yet that we offered, right? We didn't have a high yield savings account or anything. And so for us was the question of like, okay, we see where the trend is going. And so now what is going to be, our product in terms of how to, how our users can basically take advantage of those rate hikes. And then, we found it super interesting to just go directly into treasuries and just making it possible for people to own those directly. And then, I think like 6 to 9 months later, we launched the treasuries product. And that was really a little bit like trying to predict where the markets are going versus what people were asking for. Because at the time when we started working on that, no one was really asking for treasuries, let's be honest. And so that was really a thing where we had to try to time it. And I got to say that worked out pretty well. Obviously, some foresight there, but also some luck. Let's be straight. And so on. So it really has been this like combination of obviously listening to customers, but then also trying to predict where things are going in order to prioritize which asset classes to add. And the way the system is built for us is really, to your point, every asset class might have a different partner we work with. It might have a very different tech stack. And so we basically have our own ledger and our own kind of called holding system that holds basically all the positions and all the different, history of someone's account. And then below that, we tap into all the different sources. And so we have our own source of truth that we, work on, or that we, that all the accounts are based on. And then we have potential different, partners that we work with for certain asset classes. And so Apex Clearing for, stock trades, for example, right? It's backed on crypto and so on. And then basically, we have this kind of like middle layer, which makes it then possible for us to really manage this like very multi-asset type of system.
Yeah, I mean, the complexity of that can't be overstated. It's quite tough to do, and being able to offer the value proposition of alternatives and treasuries and stocks, while it sounds like, yeah, there's just things, is really difficult underneath. One thing that you differentiate on the equity side is your business model, and that you're not getting paid for order flow, which was a popular model for discount brokerage. What is your business model? How did you sort of start and think about it in the first place? And then how did you come to the conclusion about what you wanted it to be? And, has that changed over time?
I mean, it obviously has changed because we started off on payment for order flow, right? So when we started the company, we barely even questioned it because it just came, so to say, out of the box of being a stock brokerage nowadays. But we always found it a little bit weird to have this kind of conflict of interest between your business model and the users that you serve, because it definitely drives your incentives as a company, right? Like whatever your business model is will dictate what your incentives are, will dictate what your roadmap is, will dictate, what kind of user experience you build and, what kind of funnels you have in the app and so on. And so we always, call it, we're like a little bit like uncomfortable with, for lack of better wording. And so in 2021, we then made the decision to go off payment for order flow. And at the time, we were like less than a year and a half in market, And so we were still a super young company. We were very early in terms of also just building our monetization model. And so we had the chance still to build a different model because we were not yet addicted to some sort of revenue stream that we've built up over time. And so it was a little bit of a luxury position of just being early, that we still had the chance to kind of, change that. Generally speaking, what we believe is that this premise that everything has to be free for you to be sort of say like a successful, tech product nowadays and so on, is just wrong. And that most people are completely comfortable and fine to pay for things as long as they recognize that they get great value from it. And that this alignment that it creates where if you're a user of Public, you know that you're the customer and that our incentives are to build the best product for you and for not some market maker down the street, that is something that actually a lot of people appreciate. And that at the end of the day, the best brands and the best products have pricing leverage. And I think that's what you're seeing, right? Like in crypto, if you look at, Coinbase always had pretty, high fees, let's say. But they were able to charge that because, a lot of people have the perception that they're one of the more trusted players in the space, And so things like that, we believe is something that is super, super valuable and trying to build that up over time. And so for us, we do have fees on certain trades, right? We have fees on crypto. We have fees on alternatives trades. We have fees on, for example, extended hours trades. We have a subscription offering. And then also, obviously, we make money on assets, like, for example, interest on cash balances and so on. So we actually have a very diversified business model, where there's not necessarily like one major revenue stream that like drives most of it. And we believe that actually builds just like a healthier company in the end, because, number one, our revenues were therefore are not too reliant on economic cycles. And so, I think if you're too reliant on, let's call it, for example, only trading fees and, the markets start to wobble, then you will see that in your revenues immediately. And I think it's, also the notion of being multi-asset serves that as well, right? On the one side, it serves the user because they have the ability to build a portfolio that kind of can weather any type of market conditions, right? And on the other end, it also serves our business because, if we have products that people can adapt and whatever the market conditions are, that also means we have, ways to monetize whatever the market conditions are. And therefore, the revenues are just way less volatile and way less correlated to the general market conditions. And so that, we believe, is just, a major component of why, it is actually quite healthy and good to build a model where you have all different ways of how you make money and, and one way just very aligned with the user at the end.
Got it. That makes a lot of sense. Can you give me a sense of the scale of the business these days, like users or volume? What are your North Star metrics that you measure, and where are you and where are you aiming?
Yeah, we haven't shared numbers for a while, and so not giving any updates yet. But the last official number we shared was 3 million members, and that's from some point that's last year.
Cool, fantastic. I've got a question about your recent artificial intelligence feature launch, and I'd love to hear about how the brainstorming for this feature came about, what it does, and anything you can tell us about what you're seeing in terms of usage.
Yeah, so we just actually yesterday started rolling it out to most users. And I am super curious on all the feedback that's coming. Obviously, it's still very early. And for us specifically also, selfishly speaking, I think it's important for us as a company to just tinker with it.
What's it called? What does it do?
We learn as we build. So it's called Alpha. And Alpha is basically, you can think about it as like a research assistant that is powered by GPT-4. And so basically, we've fed the GPT engine with all this market data that we have that, ChatGPT doesn't necessarily directly have access to. And that is, real-time quotes, that is things like custom company KPIs, analyst opinions, that falls into things like earnings call reports and so on. And by that, it just makes it incredibly fast and easy to research any company. And so think of it as like in the app now, any stock page that you're on, if you just like kind of pull down, kind of like you're pulling down to refresh in your email app, if you pull down on those stock pages, alpha comes up and you can ask any question about the stock. And we always, obviously, like we have a lot of data in the app. We have a lot of, again, like the analyst opinions and things like that you can find on the stock pages. And what alpha really, does for us right now is the sense of making it super fast accessible and also making it easy, for example, to compare multiple companies to each other and so on.
Is it trained on the analyst reports? Like, do you have a pipe into Morningstar or something like that? And then the bot is, building on top of the GPT LLM and also can interpret these additional documents? Like, how does the thing work? What is the sourcing of it?
That's exactly it. So Morningstar data is also part of it. Exactly. And so we have this premium offering, right? Also subscription offering. And so it's basically built upon that and the data that sits within that. Another data point that we fed it are these custom company KPIs. So like on Public, if you go to, for example, Tesla, you can actually see how many cars has Tesla shipped and so on, or like subscriber growth of Netflix and these like very specific company KPIs. And so stuff like that, for example, like we are feeding it to. And that comes straight from like SEC filings that are basically being scraped and so on.
So you're kind of thinking about as a conversational interface with the data that is otherwise visualized, and maybe not all of it is visualized because it's hard to get all of the good stuff into a mobile app screen. But the questions you would want people to ask are questions about the fundamental performance of the company.
Exactly.
Do you know if that's the kind of questions that people are asking?
Well, ask me in a week from now. Ask me in a week from now. Generally speaking, the users on Public are very much more centered around fundamental data than necessarily technical analysis. That just comes from the types of users we have, right? Like our people are much more portfolio builders. They're much more interested, in, the performance of the company than necessarily trying to, speculate on just like the markets itself, And so therefore they're much more buy and hold investors that will like, dollar cost average in positions over time. And so they are more the folks that, will want to look at an earnings call breakdown, the day after earnings, for example. And those are the types of things that, Alpha is just like very, very good at kind of summarizing and giving you an overview of.
I remember this fantastic New York Times article just when ChatGPT came out, where the editor was trying to find the limits of the model and got it to hallucinate that it was in love with him. And then the model kept trying to convince him that he needs to divorce his wife and instead marry the AI model. The transcript of this was just dozens of pages long and published on the New York Times with red underlines. And I think that's when they started to put in a little bit more of the emotional guardrails. So when people ask the financial bot weird questions, what do you do? Like, Alpha, do you love me? Is my portfolio the meaning of my life? Like, how does it deal with that kind of stuff?
Obviously, it depends on the prompt and whatnot, and we'll see what kind of wacky things people come up with. But generally speaking, obviously, ChatGPT is still the underlying engine of it, and so there are still parts where it will tap into the regular ChatGPT kind of model as well, right? Generally speaking, it's very good at not falling into giving you financial advice, which is obviously the biggest thing that we would be concerned about. And it's actually very good to kind of just stick to factual information. You might have moments where, I don't know, your prompt is a little off and it can't find the exact thing. And so it gives you like a more generic answer, or you will, maybe have a moment where it, gives you the earnings call recap of, sometime in 2021 versus the last one because your prompt was a little off. Like you will have like mistakes like that come up. But gotta say, not surprised, but very encouraged by like how good it is at sticking to factual data that it was fed with.
One of the things about it that's interesting to me is that the promise of natural language processing to summarize earnings calls has been a machine learning pitch in FinTech for probably 15 years. I've seen so many companies that were like, we're going to build NLP focused on earnings, and we're going to integrate it into Bloomberg or into Morningstar or into the internal Goldman Sachs systems and so on and so forth. It was always like this, and it's hard to do. And it was always this institutional use case with people, training models specifically on investment data. And it didn't work well. And it didn't work well because you didn't have the much broader LLM, which requires sort of a completely different evolution of the underlying core technology in AI to function well. And so it's just really quite surprising for me that we're getting conversations with the earnings call of the companies that you invest in deployed at scale in retail, probably at the same time or even before we're seeing that in the investment banks. It's kind of weird.
Yeah, I think there's an aspect also of, if you're trying to augment an investment analyst in the bank, it's obviously harder to be valuable to that person than it is to be valuable to someone who does not know last quarter's numbers, out of their head. And that's why I think this might actually be more valuable to retail sooner than it is to institutional, just because in institutional, you're competing with someone who kind of already should have a lot of that knowledge, accessible in the brain right away, versus having to have to pull it up. What I think I'm generally, encouraged by, we'll see, but, hopeful of is that this natural language interface will encourage a lot of people to just do more research. And just because it's easier, they don't have to necessarily think about how is this, spelled again and so on. And so the more the model learns and the more the model maybe also learns, the words and phrases that maybe regular people might use to describe certain company KPIs and so on, which might be a little bit different than, they are right now currently in Morningstar or something like that. And the more that evolves and just the easier it becomes for a regular person to fire off a question to something like Alpha, the more research will be done and the more, folks will just also learn how to evaluate companies properly, other than just to listening to the stock tip of some friend or some random person met on the internet. And that's, I think, what I'm super kind of hopeful and, and encouraged by.
Yeah, I think it's scarier or more profound for me in that, we're 12 months into having a public chatbot, maybe, if not less. And I think it can already pass the CFA. Maybe it can get to level 1 or 2. It can definitely do just basic accounting. It can pass the bar, so it can pass the legal exams. It might be able to pass the AMCAT. I'm not sure, but it's getting there. So it's almost not even just yes, today for the retail user, there's a lot of value add because you're going from zero to some amount. And the professional investor is much further ahead or quite a bit further ahead. It's a good illustration of the fact that these AI tools are replacing white collar work and knowledge work, and that you can definitely see a world where they become really good. And not only are they then supplementing things for professionals, but could make up the gap that professionals take up in the first place.
Yeah, but I would argue also, you can see that even from the examples you just made, right, that it is basically replacing memorization. And, as someone who really sucked in high school and, was not necessarily, great in the regular school system and so on, which I would say is still very heavily reliant on just memorization. And that passing a test suddenly is so heavily just, learning, that's just memorizing stuff and putting it back on paper, that is not necessarily, really the best example of human intelligence. And that I think if we can give more people more power on just, having things memorized by just the ability to having everything available, through a quick prompt, but that the extra layer that, we then bring in any of these jobs is then the actual analysis of it, the actual kind of nuance on where things could be heading, and so on. And so I think that is also what's, at the end of the day, I think also the most fulfilling jobs and the most fulfilled work than, the types of things where you're just memorizing something, right? Like being a paralegal right now somewhere, spinning off, slightly custom NDAs all day is likely not the most fulfilling job for someone. And, and I think that being able to automate that kind of stuff, I think is actually going to be a huge unlock for all white collar workers, so to say, to just create actually jobs that can be so much more fulfilling, because the part of the job that is just a little bit like monkey work and drains your energy all day goes away. And that is actually quite awesome.
That's a fascinating point. And I'm excited that you're building this. And I'm also excited that, it's plugged into ChatGPT, and there's lots of ways others will be able to access it in the future as well. But we're out of time. And so I'd love to get our audience to learn more about you and about Public. Where should they do that? Where should they go?
First, obviously go to public.com and create an account. I have to use this to put that plugin. And then obviously you can follow Public on @Public on Twitter, for example, or now Threads, which is a cool new thing, of course. And myself, you can find me on Twitter on @Leif, Leif, and then Thunder behind that. There's a whole story to that for another time.
Awesome. Leif, fantastic to have you on.
Awesome. Thank you.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things FinTech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.